A super investor is someone who manages large amounts of money on behalf of others. They've been in the stock market for many decades and have a lot of experience. And more importantly, they've seen success. So here are some stocks that those billionaire super investors have been buying. And although they're not all the same stocks across the different investors, there are definitely some interesting themes. Our first investor is a British guy named Terry Smith, and he has been referred to on numerous occasions as the English Warren Buffett. He runs a fund management company called Fundsmith, and he is known for his 3 invest-in-step procedure: buy good companies, don't overpay, and do nothing. He has been very, very successful, and lately he has been making 2 big moves inside of his portfolio. The first stock he has been buying is Marriott International, ticker symbol MAR. And in Q3, he increased his shares in this stock by over 2,000%. At a fundamental level, this company looks pretty strong. The top line is good, the bottom line is good, the business as a whole looks very promising, but I think the main reason why Terry Smith is buying so many shares in this company right now is because it's really benefiting from the increase in demand in travel following the COVID-19 lockdown. This company does pay a dividend, however, it is very, very small at less than 1% dividend yield. So if you are a dividend investor focused primarily on passive income, this one may not be for you. They performed really well in the last quarter's earnings, and their forward revenue growth looks promising. Let me know what you think about this company in the comments below. But the other stock that Terry Smith has been adding that I want to pay a little bit more attention to, that I think is a way more interesting stock that you might want to look into, is Fortinet, which is a cybersecurity company with a market capitalization of about $47 billion. This is a company that offers other companies a complete cybersecurity package on a subscription basis. So this includes things like firewalls and risk detection tools. In Q3, he added 2.61 million shares of this stock to his portfolio. But this still only brings this stock to a total of 1.2% of the entire portfolio that he has. So it's not a massive, massive position, but it does seem that he is picking now to actually start building out this one. So we have to ask ourselves, why is this? Why is Terry Smith, one of the most known successful investors, actually deciding to add Fortinet to his positions, to his portfolio at this current time? Well, I think it's because he's looking at the macro. He's looking at the trends, and he is noticing that actually a lot of companies out there are taking cybersecurity more seriously than ever before. He is seeing the shift happen. He is seeing that the cybersecurity threats that big companies and even mid-sized cap, small cap companies, everyone right now are seeing are getting more and more complex. So companies are willing to pay more money to make sure that they are best protected against those threats. And this is all due to the growth in the cloud computing space and just with the digital transformation that we are seeing. Terry Smith may also be noticing that actually the total addressable market, the TAM, is really big and it's growing. And this company, Fortinet, they actually offer both hardware and software, unlike some of their peers. But speaking about peers, speaking about competitors, there are definitely some really strong players in this area. For example, CrowdStrike. You can see on Seeking Alpha here that they actually had a very mixed third quarter earnings report. Their revenue rose by 16% year over year to $1.33 billion, which was absolutely fantastic, but they missed analysts' expectations estimates by 20 million. They also saw adjusted earnings grow by 24% to 41 cents per share, and they managed to beat the consensus forecast by 5 cents per share. If you're interested in trying out Seeking Alpha Premium for yourself, which I highly recommend, it is the platform that I use for all of my stock research. Check out the link in the description below, because clicking on that link will actually give you 7 days free trial. You can go and try this for yourself with no ties for 7 days and see if you find it valuable. If you do, you will then get a further $50 off. Again, link in the description below. Revenue growth year over year, 26.22%, and forward revenue growth, 21.24%. So absolutely fantastic there. And I definitely think this is one of those sectors that as the world changes and we move even more towards artificial intelligence, and we just see companies spending more of their budget on things like artificial intelligence and cybersecurity, you may want to add a position like that into your portfolio. I'm not saying that this stock is the one to add. Definitely have a look at what else is out there. but I do think it is a sector that could see very, very strong growth in the upcoming few years. When looking at some of the competitors in the sector here, we can see some really big names, the likes of CrowdStrike, UiPath. These are stocks, these are companies that we've spoken about on this channel. And when I think about the performance of some of these competitors over the last 1 year period, CrowdStrike has returned investors like 200%. And UiPath about 66% if my memory serves me correctly. We'll take a look at what Fortinet's been doing in just a minute, but potentially there could be some, short-term upside to this company compared to some of the others. But obviously do your own research. So over the last 1 year period, this stock has returned investors 27.56%. So it has managed to outperform the S&P 500 index, but I've compared it to CrowdStrike and UiPath here as well, just so we can see a comparison. CrowdStrike way outperforming, way outperforming. And then when we look at a 3 year period, Fortinet absolutely outperforming CrowdStrike, UiPath, and the index, returning investors 110%, which is absolutely fantastic. And that is even including this massive sell-off, this massive plummet in the stock price that happened after the Q2 earnings. We're going to move on from Terry Smith now and move to Bill Ackman, who is definitely one of the most known and successful, one of the most popular investors ever. And lately he has been buying 973,000 shares of a particular stock, increasing his shares by 10.4%. This stock that he's been buying is now the second largest position in his entire portfolio, taking up 17.9% of it. What's the stock that he's been buying so many shares of, you ask? It's Hilton Worldwide Holding, also just known as Hilton, which is of course known for its global hotel chain and franchise operations. Marriott International, that we saw with Terry Smith, and Hilton, that we're seeing with Bill Ackman, have some similarities. They are both within the same sector. And just like we saw with Terry Smith, Bill Ackman is also very bullish on the post-pandemic recovery of this stock. He thinks Hilton stock will continue to soar in 2024 and the travel sector will experience much more recovery in years to come. But he could have picked from many stocks within this sector, so why is he selecting Hilton specifically? Well, it's because he believes that the Hilton's brands will remain relevant forever, and this stock will just be a cash cow that he will continue to hold and it will continue to make him money. Bill Ackman's publicly traded fund actually now owns about 3.3% of all outstanding shares in Hilton stock, and they started their position in this company in Q4 2018. Seeking Alpha analysts and Wall Street analysts are also agreeing with Bill Ackman and currently rating this stock as a buy. The total revenue seems to be increasing nicely on an annual basis from 2020 to 21 to 22. Some very nice growth there, but we can see that actually between 2018 and 2019 to 2020, there was actually a fall, and it makes complete sense as to why, given which sector this company, this stock is actually in and what was happening in the macro world at that time. Seeking Alpha is rating the forward revenue growth as an A, 23.82%. So also agreeing with Bill Ackman here. 1 year performance is very strong, outperforming the index 35.49%. 3 years also pretty strong, outperforming the index 61%. 5 years again outperforming the index. This shows you how good this company is at a fundamental level, outperforming the index in all these different time periods, 153.37%. And an absolutely amazing performance over the last decade, way outperforming the index, returning investors over 340%. And Hilton's success in the stock market with these sort of returns in the past decade, I think is due to its asset-light model. This approach involves Hilton not actually owning the hotels themselves necessarily, but rather franchising them to others and managing them for fees. This strategy is very smart because it allows Hilton to earn high margins without the costs of actually owning the properties. Going back to the last 3 years, we can see that Hilton stock is actually at an all-time high right now, yet Bill Ackman is deciding to buy this stock. Why is that? Well, like we said, it's because he believes that this stock still offers great growth in the future. And this makes you realize that the stock price is not always a thing that you should be looking for. Just because the stock price has gone up by a crazy amount in a given time period, it doesn't mean that you shouldn't still buy a particular position. Investor Cathie Wood, who is the founder of ARK Invest, and ARK Invest manages different ETFs that primarily buy those innovative, more disruptive companies. And they have been recently adding one particular stock to their portfolio. On the 4th of January, she added 27,324 shares of this particular stock. And that stock is Rocket Lab, ticker symbol RKLB. You may not have heard of this company before. They are not so known as Tesla, Nvidia, Amazon, but they are a mid-cap company that they're definitely growing in popularity among retail investors. They are a spaceflight company that offers affordable launches for small satellites. They utilize their efficient and lightweight Electron rocket. From what I can tell though, their launch provider side of their business is actually becoming a smaller part of their overall business as time goes on. And their space systems is growing. And we'll talk about some evidence to back that up in just a second. But Rocket Lab focuses on reducing the cost and increasing the frequency of access to space. They cater mainly to commercial customers like satellite operators, but that does seem to be shifting. Because recently they were awarded a massive $515 million contract to build 18 satellites for a US government agency. And since the company's announcement of this deal that happened on the 21st of December 2023, Cathie Wood actually increased her position in this stock by about 380,000 shares. She is very, very bullish on this one. So why was this contract so important? Well, firstly, it signifies a major revenue boost, potentially improving their financial stability and growth prospects for the future. Secondly, it involves a high-profile government agency. I don't think that agency was necessarily named, but this is a big shift in the type of organizations that are looking to Rocket Lab. And this could, of course, enhance their reliability and their reputation, which could then lead to more contracts from big organizations at later dates. This is definitely a company, a stock that is worth looking into if you are an investor that wants exposure to this space industry, to the space sector. Maybe you would quite like SpaceX in your portfolio, but of course that's not one that's publicly traded, so you can't get that. But I would for sure take a look at this one. I'm trying to learn as much as I can about it right now. Haven't currently got it in my portfolio, but who knows for the future. In a 1 month time period, Rocket Lab has returned investors quite a good amount, 11%. But look here, notably the shares increased by a substantial amount around this time. What happened here? Well, these dates coincide with that government contract announcement that I was just telling you about. It seemed like as soon as retail and institutional investors, even maybe Cathie Wood for sure, heard about this announcement, they started to accumulate shares. And the share price is driven by supply versus demand, and that's exactly what happened here. The demand was suddenly increased in this stock, and the stock price went up by a lot in a given day. And since then, it hasn't really dropped down to pre-announcement levels, but it has definitely been very volatile. Over the last 1 year period, Rocket Lab stock 14.41%, not quite outperforming the index, but doing quite well. And you can see it's way more volatile. A smaller mid-cap company, growth stock, it is going to be more volatile than the index itself. 3 year period, down by about 50%, but you can see that it only went public very recently. And typically, like we keep saying on this channel, when a stock goes public through an IPO or a DPO, you do see that massive surge in stock price, and that's not always a true reflection of the stock price that it is going to actually trade at. And like with many companies, Rocket Lab did the same thing, went crazy up, and then it sort of came down to more reasonable levels. Now, I'd love to hear your thoughts on all of the stocks discussed in today's video. Let me know if you own any of them or if you're considering adding any in the comments below. Stay tuned for the next video, but until then, keep analyzing, keep investing, and don't forget to hit that subscribe button with the notification bell on so you are alerted next time I post.